Good morning, everybody. And I'm joined today by a very illustrious panel of my European banking colleagues. And we're here to give you the C-suite view on what's going on in Europe right now. And certainly the experts on the panel, I've no doubt, will tell you why the European banking sector is now well placed to actually cope with all the challenges that are actually heading their way. And I'm sure, despite some of the statistics that we've already heard, some of them, but there is an argument, of course, that European banks at this point in time, despite changes to the EU regulatory framework, is actually less competitive vis-à-vis other regions around the world. And European banks, we're here in the States. If you actually compare European banks on crude economic measures with US banks, then it would suggest that the European return on equity at 6.5% underperforms that of US banks, who average some 11.5%. And the cost-income ratio of European banks is increasing, whereas the US data, most recent data, suggests that theirs is decreasing. And in terms of consolidation, the US banks have actually consolidated more since the financial crisis, whereas the European banks are actually quite difficult to see how that consolidation can and will happen. So I think the Basel Committee in March of this year actually refined their view on the way in which Basel III and IV would actually affect the capital requirements for those banks in different regions. And in Asia, they said that effectively there would be a reduction of the capital required. In the US, they said that it would be 1.5% increase in capital required. But for European banks, they suggested a 20% increase in capital requirements. Some quite big differences. So the panel's going to discuss some of these challenges that European banks are actually facing, and actually maybe touch on some of the structural things that are affecting the European banking sector, and what might keep some of those European banks from performing better over the short term. But they are real experts, and so I'm going to allow them to actually discuss these topics for you. And hopefully by the end of this session, we'll have a real good feeling on whether or not the European banking system is well placed for potential global or indeed even a European economic downturn, and whether or not the European banking sector is well placed to cope with the new digital agenda and fintech coming along, and whether or not the banking system, of course, can advance that ESG agenda that the previous panel has been talking about, given that Europe is probably one of the leading regions in terms of legislation in this field. So my panel, as I say, is well placed to actually discuss this. So from my left through to my right, we have Howard Davis, who's the chairman of RBS. We have Jean Lemierre, who is the chairman of the board at BNP Paribas, Andreas Treichel, who is chairman of the Ernesto Group, and Martin Zelka, who is the managing director, chairman of the board of managing directors of Commerzbank. So a good cross-section of European banks here, and I apologize to all of them if I've got the pronunciation of their names a little inaccurate. I'm sure they'll correct me. But we're going to start the session now with a question here to Jean on whether or not global standards and the regulatory cooperation are actually enhancing the role for you as a European bank. What are the risks of fragmentation, and whether or not the EU is actually going to have a single banking market that will then benefit from the free flow of capital and liquidity? Only a small question for you, Jean, to start off with.
Good to see you. How long do you give to me to answer to your questions? You know,
take the hour. Take the full hour.
The longer you take, the less your colleagues have got to question you on your answers.
Good. No, I'll be short, because you have painted a picture which is slightly provocative, which is your job. But it's not the truth. I appreciate you help me because I can say this is not the perception we have. And so what are the positive factors? Europe is okay at the political level. This is very clear. There are different countries. Political life in countries are changing over time. I would not say a word on Brexit. Howard will probably, but I shall not. But there's unity, there were good European elections, there's a commission, there's a new leadership in the ECB, which has been decided very quickly. It's okay. Italy is perfectly well on board, so it's okay. Because this is the trickiness about presentations in the IIF, you know. One year you speak about Italy, the other year you speak, okay, it's okay. From my point of view, we operate in many countries, it's okay. We have a new commission, maybe we speak about this, about what they want to deliver. The economy today, when I meet clients, it's okay. They have projects they want to invest. And by the way, non-European banks are quite active in Europe and they make money. And this is the, it's like the British pudding. The quality is in the banking. If it was so bad as you describe, we would have no American competitor in Europe. Huh? But we have. Welcome. So it's okay. Now, it is true that Europe has embarked on a very difficult process, which is to shift from a bank-based funding to a market-based funding. Good or bad, this is life. And you cannot criticize the reform. Because when I come here, say Europe doesn't accept reform. There is a reform, which is this one, which is difficult. By the way, the reform was made in the US some years ago, and it has taken time. And it has to be acknowledged. And we have a monetary policy which has been, and you know what it is, has been decided a few days ago with negative interest rates. Maybe because of the European situation. I'm not in the minds of Mario Draghi, but definitely about what's happening in the world. And what's happening in the world, notably the shrinking of the global trade, has an impact on Europe because especially Germany has a remarkable success on trade. But there is volatility, and sometimes it goes very well and sometimes less good, and there is a need for adaptation. And this is where we are, and the monetary policy is supportive. But we are shifting the model. And we are integrating the banking system in Europe. So on your question about fragmentation in the world, yes, it's a difficulty. But may I insist on the fact that this is not a difficulty only in banking. It's a global difficulty for all the activities. We begin to see more fragmentation. Even when I go to Singapore, people speak about a shift from globalization to bifurcation. You know, these are serious questions. And of course, banking is taken into that debate. And the more we resist, the more regulators resist, the better it will be for the banking activity. I'll stop here because I'm sure you will ask me or my colleagues questions about what's happening in the banking sector in Europe, meaning consolidation. I would like simply to say one word. In English, consolidation means mainly for investment bankers mergers, acquisitions, maybe fees. But the reality is about consolidation of market shares. And if you go a step further than the amount of fees on the table, you will see that there is a real consolidation within the banking sector in some business activities. And this is the way it will happen more and more. So yes, the banking sector in Europe is adapting to the new paradigm of a single market, of a great success, which is the ECB supervising the banking industry. We welcome, and they do well. And we see consolidation of market shares. And even with the new interest rate policy, and unfortunately maybe for long, you may see in the future further consolidation of market shares. So yes, the banking sector in Europe is changing, moving, adapting. It is the process. It's not over. It will continue, but that's the way it should be.
Thank you, Jean. And Howard, with regards to your experiences of cross-border regulators and cross-border supervision and the way that the world looks to you right now, have you got any words of wisdom for us on that area?
Thank you. Let me start on a positive point. You asked about pronunciation of our names. You got my name fine, which, since you're Welsh, is perhaps only to be expected. I did think that like Jean, I did think that your presentation was a little bit downbeat on the European banking system, though you make a fair point about costs. And when I get back, I shall look at the scale of our billings to KPMG to see if we can't make any savings there. But I think on cross-border regulation, I would agree with Jean that the ECB has been a success. They obviously don't regulate RBS directly, but we own a quite sizable bank in Ireland, which is regulated by the ECB. So we can see and make those comparisons. I think that works okay. And I think that on exchange of information, I think regulators have come a long way, and banking regulators, I think, more than other regulators, probably than insurance and securities. So I'm quite positive about the way the cooperation has worked. Now, we're going to depend on that post-Brexit, because an alignment between the London markets and the EU will not be possible without close regulatory cooperation in a number of areas. So I think that's something which we do need to work on, and I hope that the ECB and the Bank of England are thinking hard about that at the moment. I think my concern is, and you talked about the capital position, I do think it is the case that the eventual outcome of Basel 3.1, as the regulators like to call it, and Basel 4, as the banks like to call it, was a solution that does, as you alluded in your introduction, have rather different consequences for European banks on the one hand and American banks on the other. And it's partly, as Jean said, because of the different structure of financing, where European banks do have more high-quality, large corporate loans on their balance sheets, and they also have more mortgages on their balance sheets, which are not typically securitized. And that means that Basel IV, let's call it that, does have a larger effect on the capital of European banks. Now, finally, however, on a positive note, I mean, in your introduction, you sort of asked two questions about whether we were equipped to deal with a potential downturn, and also whether we were equipped to deal with digital challenges. On the first, I would answer, certainly for part of the UK banks, and I think most of European banks, on the first, I would say yes, and very firmly. I think that the recapitalization of European banks has gone a long way, and with, in our case, more than 16% core tier 1, it would have to be a biblical recession in order for us to be challenged on capital. Digital perhaps is more tricky. I mean, there are some new competitors that are more difficult to deal with. And that loops back finally to your regulatory point. I think it is rather important that regulators internationally cooperate on regulating new digital ventures and ensure a level playing field. Because I think the banks do have a legitimate concern that they are being held to a somewhat higher standard on AML, particularly, than some of the new competitors are. So I would like to see more effective international cooperation between regulators on setting standards for neobanks and new fintech competitors, which are on a level playing field with those of banks.
Thank you, Howard. Now, I'm very nervous here, given I spent 10 years writing some of that financial services legislation that everyone have had such a hard time implementing. But I think on the question of your business models changing, digitization and what that means for you, Martin, would you like to talk us through what your views on this subject are?
Well, Martin is easier than Silke.
It is.
Very good. Well, I think from the strategic point of view, microphone. Could you change it?
You should go the old way.
Oh, I got to go the old way.
Yeah.
Thank you, Jean. So that's a perfect signal of cooperation, isn't it? Oh, and another one. So from a strategic point of view, I would say banks, especially European banks, are facing two main challenges in the moment. Of which one is a real challenge, and the second one is more, in my view, an opportunity. Let me start with the challenging one. So I think European banks have to adapt to, let's say, a combination of subdued global economic growth and low interest rate environment. And I would say the European banks, in fact, have not a low interest rate environment, it's a negative interest rate environment, which really makes the difference if you go to that. So, and that combined with geopolitical uncertainties, cost of a Brexit, for example, and other trade, let's say, discussions, create a situation which is really a challenge. So banks have to adopt their strategies on this situation because we have to cope with it. And for example, Commerzbank, with our recent strategy, clearly focused on our strengths. We reduce our cost base via our branch network. We focus on mobile, come to digitization later. And we focus on our core corporate business, for example, if we use our sector approach for from 100 to 500 European customers and so on. And importantly, from a strategical standpoint, we put together our direct banking approach together with our branch-based approach because both coming closer and closer together. So this is one of the answers of the challenges on the model side. I think a second important point there is sustainability. I think we heard that in the panel before. Sustainability will be much more important for societies, and I'm absolutely sure it will be important for institutions, and of course will be important for banks, because I believe that a bank can only be a trusted partner if we really can put something to the society which is important for the society and is accepted by our customers. So therefore it will be a real important challenge, even if investors are a little bit neutral on that. Let me take it like this in the moment, but I think that will be an important trend. But let me come to the second aspect, the second challenge, which is more an opportunity. I think digitalization is a challenge and an opportunity as well. I think we have to accept that digitalization is transforming the whole industry, not only the banking industry, but also the banking industry. So we have to adapt this as well into our business models. And that means, for example, it was mentioned before, collaboration with fintechs is important. But we are talking too much about fintechs. We have to talk about big techs as well. And from the banking standpoint, it is very crucial that we have a real level playing field on regulatory areas with big techs, because what we learn is that a lot of these technological firms use parts of the value chain outside of regulatory areas, make a lot of money with it. And I think that's fair, but we need, as banks, clearly level playing fields to play in the same field and make our efforts there. And therefore that is, in my view, very important. The same to usage of data. It's again big firms who are, let's say, doing the first steps there, or did the first steps there. They are firms that really live from using data. Banks have, in part, better data about customers, but we need to use them. And that's not only a technological topic, it is a regulatory topic as well. So we need to understand how can we do it in a similar, in a level playing field area, to use this as an opportunity for our businesses. And that's true, as, again, for technological questions like cloud services. For example, in Europe, I think all the banks, I'm sure all the colleagues will be with me, we need cloud services to offer our clients acceptable services. But regulators see it quite skeptical at times. So we need to have this debate to use the opportunities of modern technology. And for example, you can go further. I don't have the time, I think, there for if you see blockchain technology and something else. We need clearly the regulatory support to both provide our customers with innovative products and to be competitive with our non-banking competitors. And that means level playing field. And that, I think, is one of the, let's say, challenges in the digital world.
So it suggests to me that the world is changing and that with these potential new entrants, we shouldn't be looking at the traditional banking model and consolidating within it. We should be potentially looking at a much bigger picture as to where banking services and how they get delivered going forwards. I think I'm a little, as a former M&A banker, you do get a little nervous that the traditional methods of consolidating maybe are not the way that you need to look at the world. But Andreas, you're actually, I understand from my stats that my team have dug out, the longest serving chairman of a European institution, credit institution. And therefore you've seen trends come and go, and you have a different focus to many of the other panelists here, where you have a very big focus on Central and Eastern Europe, where maybe the growth rates there are a little different to some of the larger member states. Maybe you'd like to talk us through your strategy and where you see the opportunities in Europe right now.
Okay. Thank you very much. As you know, Martin is German. I'm Austrian. Austrians have been very good in making the world believe that Hitler was a German and Beethoven an Austrian. But the real, although we speak approximately the same language, the real difference between us is that the Germans say the situation is serious but not hopeless, and the Austrians say the situation is hopeless but not serious. So I will give you my view on Europe from an Austrian standpoint. I think first of all, I think I've done my dues in consolidating. So I don't have to do that anymore. I did my share. And the situation that we have in Central and Eastern Europe is a situation that should give European politicians some food for thought and European regulators some food for thought. Because if you look at the situation of European banks for the moment, I fully agree with Jean, whom I really admire because he has such an incredibly stable personality, and you're always relaxed and always positive. That's really great. I would love to be like you, but I just can't. There are two regions in.
I'm not so sure it's a compliment.
There are two regions in Europe that do rather well in terms of banks, which doesn't mean that they are better banks, but their valuations are better. One are the Scandinavians, because over the last years you had the state and the economic and the businesses much stronger aligned in terms of digitization. So they have superior cost-income ratios to most other European banks, and therefore, if it wouldn't be for the money laundering, they would all trade well above book. And if you look at Central and Eastern Europe, you will find that most banks that are active there do also have valuations well above book. Now, by coincidence, most of the European banks that actually create values above book, not a tangible book, but real book, are banks that have a major part of their business outside of the Eurozone. And that should give European regulators food for thought, because one of the reasons why we are better valued than many other banks is, of course, because of the brilliant chairman, but maybe also because we have much stronger growth and much better margins. That's as simple as that. The second food for thought is that most, actually all, Central and Eastern European banks have substantially better cost-income ratios than Western European banks, not because they have only because they have a better top line, but because it's also easier to manage costs in Central and Eastern Europe, because they do not have all the benefits of the social welfare environment that we have in countries like Germany, Austria, or France. So in our own bank, our cost-income ratio in Austria is a lot worse than our cost-income ratio in the Czech Republic or Slovakia or wherever we are. So one of the reasons why Central and Eastern Europe is a good place to be for the moment is because it's more entrepreneurial and because it has better growth patterns than the rest of Europe. Now, we do have strong banks in Europe, I agree, but we don't get credit for it for the moment. And the fact that the whole European financial services industry, the listed European financial services industry, including UK and Switzerland, is valued at less than Apple or Microsoft for the moment. So there's just one company is worth more than all the banks, including Santander, including BNP, including all the large banks. That's not good. That's not nice. And that tells you a story. And the story is that we do not have a European banking market. We do not have a united European services industry. We have a united European product union, and we have had free travel in Europe. Those were the two accomplishments. We didn't even manage to get to one currency because we're split. And we have a big upcoming problem, which we decided in 2015 to tackle, which is a European Capital Markets Union, which we do not have, and in my view, we will not have for a very long period of time. And because of that, Europe will be at a constant disadvantage vis-à-vis the United States of America and other places in the world, most of them in Asia, that are working heavily in developing their capital markets faster than we do in Europe. So I'm positive on certain European countries. I think that Europe still has a great chance to make it, particularly on the field of environment and sustainability. My guess is the chance is substantially higher than 50% that we're going to screw it up.
Okay, on that very negative note, this is going to involve politicians coming together to actually have new priorities in order to get that single market, particularly for services, to work better. And for banking in particular, we need to finish that banking union component of the regulation and getting people to work in a much more cooperative way. So these are all political issues, and geopolitics in Europe right now is particularly interesting, as well as having the entirety of the Brexit discussions. And yesterday you've seen that there's a new package on the table again. Not that we've been here before, but I'm hoping this time that my politicians in Westminster might see fit to actually vote for something finally, and we can move on out of the situation we're at. But alongside those Brexit discussions have been a new parliament in Brussels. The European Parliament elections earlier this year have actually led to a new parliament who are already starting to show their teeth And last week we saw them reject the French commissioner designate, and therefore it's caused major uproar, as well as rejecting the Hungarian and the Romanian commissioners designate. So they're already starting to show a different political will. And that new commission coming into place was expected to be the very next day, the same day as Brexit was going to occur on the 1st of November. Because of the Parliament's votes already, we're seeing that that new commission won't be in place until December at the earliest. So what would you like to see from this new commission? Where are their priorities going to be? I mean, they've stated they're going to be the greenest commission yet. They've stated they want to be at the forefront of technology with AI and a European cloud. Not sure what a European cloud really is, so maybe somebody might be able to pick up on whether Europe needs something that isn't American corporate-led, and whether that's a suitable priority in the world we live in at the moment. And I really do feel that we do need to actually understand, and I think the new commission needs to understand what banks and what financial intermediaries need from them in order to be able to facilitate the growth of European companies in the short and medium term. So they have a 5-year strategy. Jean, would you like to tell me what you'd like to see the commission deliver for you?
Yeah, first, I hope that when I am the longest serving chairman in the banking industry in Europe, I shall be as constructive as Andreas. I admire you because you still have give the momentum to the process. Well,
that's European consensus, isn't it? That's European consensus, isn't it?
It is. No, it's leadership. Yes, and wisdom. No, to be maybe very specific to answer your question. I think the first point is to move on the banking union agenda, because we are still in the middle of the water. A lot has been achieved. We need to move on. And if there is one measure I think important is in the European mindset, you know, in between the capital market union and banking union, it is securitization. The level of securitization in Europe today is lower than before the crisis. And you cannot have higher capital requirements in banks without the possibility to shift assets. By the way, this is exactly what the Americans have done in the 60s, reforming the banking sector. At the same time, they have increased capital requirements, and they have organized a government-subsidized securitization system for mortgages, which is always forgotten in Europe. Mm-hmm. I do not think it should be government-subsidized in Europe, but it is in the US. It is not market-led. But the Americans have created a system which is consistent, and it helps rotating assets and income with the same amount of capital. That's crucial. And it doesn't exist in Europe, or very limited, for various regulatory reasons, in which, unfortunately, the subprime crisis has created a stigma. And that's a very serious question. And I think the EU Commission should move on and start again thinking, and we know how to do, but to move on, that's key to address the questions you have put on the table. By the way, if you want mergers of banks, and especially cross-border mergers, the ECB wants, you need to be able to reduce the size of the balance sheets. And you cannot do it if you don't have a securitization system. That's all. So it's extremely clear. The Americans have been consistent by putting public support to this, not market-led. I insist on this. And probably we should do something like this, and this is quite urgent. That's one, I would say, low-hanging fruit, but I know it is difficult in Europe for various reasons. The second element is really to insist about investing in research and technology for the whole economy. This is very important. We do better, we do more. It's a very capital and resource intensive activity, and there's a lot to do, and I'm sure the new Commission will do it. The third point would be to try to build up a consistent green agenda. Because in Europe, each of us, we are very committed to this. We do a lot in banking, we do a lot in many sectors. But member states may have different views about looking at what should be done, especially in the energy sector. And it would help a lot that there is more clarity, consistency. It would help a lot, notably the banking sector, to understand well what should be done. If I may insist on a small part of the equation, that we don't pay attention only to what is green and not green, but that we pay attention to what could become greener. And the transition dimension of the story is extremely important. There's a lot to do. We need skills, we need to define new products, you need to define new measurement, new data, new technology to measure progress, and this is a massive value added the banking sector in Europe can create, and hopefully not only for Europe.
Mm-hmm. So Martin, the ECB was mentioned there. Of course, one of the other big changes that happens on the 1st of November and how buses come along in threes, you know, 3 big events happening all at the same time, Brexit, new commission, new ECB president. And these are really big issues. On the basis in my 10 years in the Parliament, the biggest change, I believe, happened when the changeover happened between Trichet and Draghi. When Trichet said, I have a large balance sheet, I'm not going to use it, and Draghi came to the Parliament and said, I have a big bazooka and I'm going to use it. And that 2.7 trillion euro and rising balance sheet is the end product of that big bazooka moment. So what do you see the new ECB president coming in and having as her strategy with Ms. Lagarde, who is very famous here within the IMF sort of circles? How do you see her new role and that of the new executive board developing? So in the same way that Jean has just said what he wants for the Commission, what are you looking for from the new ECB executive board?
It's an interesting question. Before I come back to this, I learned a lot about the differences between your country and Germany. And I have only one difference. Another difference, what I learned is, I would say it is the opportunities for Europe are better than 50% than lower. But coming back on the ECB question, before I look in the future with you, I would go back in the past a little bit, and I would say if I would judge the policies of the current ECB team, I would say they did a real good job when they started with the consequences after the financial crisis. To make that quite clear, and I think as a banker we have to consider this for a moment. Having said that, I would say after a long while of having low interest rates, of having QE policies in Europe, after a long while we have to analyze, or ECB has to analyze, the consequences, the long-term consequences for, not only for banks, by the way, or financial institutions, but also for societies, for pension funds, for all the firms who have to save money for the pensions of their employees and so on. And there will be, that is what I see and a lot of economists see, there will be more and more unintended consequences of an ongoing, let's say, extensive monetary policy. And the positive effects, which we really have seen in the past, the positive effects become lower and lower because after a while, negative or low interest rates do not have the power for the real economy that they had in the beginning of this part. So the challenge, I think, for the new ECB team is really to find, in my view, find a way out of these, I would say, trap. And this is not easy. It is not at me or at us to give them the right advice, but I think we should clearly see, we should hope that the new ECB management will find ways to really find a way out of this trap. And we need to do this even faster than later, in my view.
And Howard, you've got operations both in the UK and in the Eurozone, with your operations in Ireland. How do you see this low interest rate environment playing out, and what would you like to see as being that way out that Martin's just referred to?
I think that it's important that we don't expect too much of the ECB in the next few years, because they do not have that much left to give. They can't, I think, put interest rates much further down. I think there are all kinds of technical problems with negative interest rates, which I think we'd all agree. They can carry on with quantitative easing, but I fear that they're pushing on a piece of string here, and it's not clear that, if you look again at the Japanese analogy, that keeping on with a very, very low interest rate environment will actually encourage further credit creation. I mean, this makes the banks less robust, less profitable, and doesn't necessarily encourage expansion of banks' balance sheets. So I think that it would be wrong to focus exclusive attention on the ECB in terms of its future policies. I personally am of the view that there is a fiscal response that is going to be needed, more in some parts of Europe than in others. Some parts of Europe are more capable of a fiscal response than others, and that to expect the ECB to be able single-handedly to to sustain a European recovery at a rapid rate is, I think, something is just not going to be possible. I think we are approaching the limits of what central banks can do, and other economic actors need to take their responsibilities.
I'm going to turn this into a last 10 minutes of talking CMU and what we can expect from a markets-based finance rather than just the traditional banking. And of course, as banks, you operate across both of these. So Andreas, with your CMU hat on, what are you wanting to see develop? I mean, how are we going to achieve what I've certainly failed in 10 years to do, which is shift the dial considerably on some of those measures we need to get a single market in capital markets working?
Okay, maybe just continue on regulation. I fully agree with what Martin said, is that the European regulators and politicians actually did a really good job in 2009, and they made the European banking industry a lot stronger. But what they have missed was the point in time when regulation turns from being a stabilizing factor into a destabilizing factor. And one of the key issues for the banking union in Europe would be for regulators to say at some point in time, that's it. We did it. We made the European banking system a lot safer. Now we're not going to add another thing and another thing over the next years. We got to a point where we say, we're strong, let's keep stability for the next 10 years. So that is one point that we would need. We would need some, and I have some hope that we at least do not go more negative in interest rates. And Mrs. Lagarde is, I think, a very wise woman. Hopefully we see some form of relaxation in the future. And we have to realize that one of the problems of Europe and European banks is that they're too big. European banks finance over 75% of the European economy. In the United States is 25%. So we need a capital market. In my view, actually, the most important reason why Europe is way behind on digitization and artificial intelligence is not that we don't have the people, we don't have the capital. We don't have the startups, we don't have the capital market culture that you need in order to create startups. Our startups leave much too soon and go for capital in the UK or the US or somewhere else. So we have to start with capital market culture in Europe, and we need it. Now, in order to develop a capital market culture, you need politicians who are willing to install taxation systems that are positive for capital market culture. You need transparency. You need corporate legislation that enhances transparency. And you need unification. All those things are desperately needed in Europe, and I have relatively little hope that we actually manage to get it done. Because if you think about what will happen during the next few weeks, there are 2 countries in Europe that have a long-standing and developed capital market culture. One is Switzerland, that has never been in the EU, and the other one is the UK. That's about to leave the EU. So my hope that this will actually happen is limited, but it's desperately necessary in order to bring the right balance into the European financial system. Not only do we need a capital markets union, but we need financial education. People don't know anything about capital markets in Europe. Our clients don't know anything about it. They're being taught by politicians and even Christian democratic politicians in Germany and in Austria and wherever. If you ask them honestly, what do you really like about German industry? They say, yeah, it's nice to have BMW and Mercedes and all those big companies, maybe not so much Bayer anymore. But the backbone of the German industry are the family-owned businesses. They are sustainable, they're strong, they don't go for return on equity, they don't have issue quarterly statements. So actually, we'll live off these people. And the capital market companies are speculators. They have to issue quarterly results, and actually they're bad. So if you teach that to people, and you say, being private is actually serious, going public is speculation and it's capitalism. There's no Christian democratic politician in Europe who even dares to speak out the word capital, because they fear that they lose votes if they're called a capitalist. It's dramatic, because they're enticing people to put their money into the bank where they get nothing, buy building society contracts where they get nothing, buy life insurances where they get nothing, buy government bonds, happy if they get positive or zero, most of them are negative. So all those things that in the European context is serious saving, you lose money. And all those things where you can make money for the moment have the title instruments for speculative capitalists. So this needs a complete change in culture. And the 2 countries that have this culture have very soon no influence on the European Union anymore. So all my hope is on Madame Lagarde.
Okay, so we have time for a last intervention from each of you if they're quite short. But what I'd therefore like to ask you is, how do we turn the European savers into European investors? And how do we embrace something like the ESG sort of issue that's coming up, and maybe get a new group of investors out of the next generation of millennials who are a little more engaged in some of the environmental and ESG issues? Can we use this as a turning point to maybe try and persuade that new generation to get involved in that investment culture? Martin, if you want to start your...
Yeah, absolutely. I would say yes, absolutely. And I would support Andreas' view on not only the German, but most of the European consumers. We need to give them the products and the approach and the support, even the political support, to really understand that capital markets is not a bad banking thing. It is a very creative and very positive thing that creates welfare in the societies and so on. And maybe you are right, maybe the whole debate about green, sustainable investments could help to trigger this in the consumer's understanding. And therefore, I think, not only therefore, but it is another argument why this is so important, not only for the financial industry, but for the whole, let's say, European society, because that is an opportunity for us to bring them into their minds that investment is not a bad word. Investment is purely positive for themselves, for the individual, but also for the overall economy and the overall society.
Sure.
Well, listening to the debate, I think it would be much easier to change the name of Capital Market Union and to call it Saving Market Union. I think people will understand better what it is. And at the end of the day, the question is to offer European savings decent or some return on their investment. May I remind you that Europe is a net provider of savings to the world, which is not the case of the United States by far. And one of the key questions for the future, for us and each of us, is to offer European savings decent return, and notably German savings a decent return, which is going to be challenging in the current monetary environment. And you are going to see massive flows of capital, notably across the Atlantic. And I think this is what we see today. A sizable portion of the German savings are flowing to the US Treasury simply because they find a negative interest rate on the Bund or the OAT, and they prefer being safe to invest in US dollar. So that's a very important debate for the future of Europe. And it goes to your question. The more we can offer products, class of assets for European savings, the better it is for Europe, notably if they are in Europe. And I don't want to go back too much to the idea I have expressed about securitization, but it's clear that a package of mortgages in Europe is a very safe asset with a decent return and would be a very good investment for savings in Europe. So working on the capacity to create a new class of assets, avoiding bubbles, because that's the other danger of cheap money, is a priority for Europe. And having this in mind, green is key. And in the new class of assets, bringing on board energy efficiency, climate change, green, is clever. But the key question in the near future for Europe is to get positive return on savings. So please, let us speak about a saving market union. That would be much better understanding in Europe.
And Howard, I give you the last word.
Well, as Andreas said, we do have more of a capital market in the UK, and also we have a rather higher rate of business formation, not necessarily, or not particularly actually, UK citizens, but a lot of people come to London to set up businesses. And I think there are some lessons in our experience of tax-relieved investment schemes, venture capital trusts, enterprise investment schemes, etc., which have actually been quite successful in promoting investment in new ventures, and I think they could be adapted on a European scale. So I'm always reluctant to invent completely new things. I think we should look around Europe at what has worked in terms of these incentivized saving schemes which direct money into new ventures. And I think there are some examples in different places. No doubt there are some others elsewhere in Europe which we could copy on a European scale.
Well, with that, we're actually out of time. So I think we've demonstrated we can have European consensus on this stage at least. So thank you all very much. And I'd like you all to join me in thanking Howard, Jean, Andreas and Martin.